Hello.
Welcome
Hello.
to our session here today. My name is Kevin Lancaster, and CEO of Channel Program, and our goal is to bring as many amazing resources to the marketplace as we can. And today, I think we have a really amazing resource that's actually applicable for both sides of the marketplace, for both the vendors and for the channel for the MSPs. Today we're going to be really MSP specific, but it's funny enough, I was having a conversation with Jeremiah Todd over at TimeZest this morning, and mentioned he's a partner here with Capchase as well. So it was very timely to have that conversation. But we'll jump right into things. First, I want to welcome both Maria and Adam to the session here, Capchase, and we're going to go through Capchase and why this is really interesting, especially given today's dynamic where there's hyper growth going on in the channel, conflated by, I guess some economic uncertainty or misdirections. I don't even know how to describe it these days. But with that said, I want to turn it over to both Maria and Adam to take everybody through a rundown of Capchase and really this concept of non-dilutive financing and how it could be important or very helpful in your business as you move forward. So with that, take it over, Adam and Maria.
Thank you, Kevin, and thank you everybody in the channel program team to inviting us here to speak to all of you. So thank you for joining this webinar as well. We're really excited to tell you a little bit more about different financing resources that you can get access to kind of accelerate your growth and really go to the next level. So we have a brief presentation where we're going to walk you through what different financing options may be available to you. And then at the end of the presentation, we're going to have a Q&A session. So feel free to start dropping in questions in the chat. We will address those at the very end. So without further ado, quick introduction on who Adam and I am. So I head up our partnerships team at Capchase, and for those of you that don't know who Capchase is, so we provide financing resources to companies with recurring revenue to really help them accelerate their growth and they can go to the next level. And I'll hand it over to my colleague Adam, who will kick us off.
Hi, everybody. Thanks for joining us today. It's great to be here. So yeah, we're really excited about MSPs. Maria, can you flip to the next slide? So the reason we're really excited is we know in recent years IT services have changed a lot, and went from maybe billing for software and hardware, and then some project-based services to bundling everything and basic overall value that you're providing. And with that change, it's turned MSPs into really strong recurring revenue businesses. And I think like a lot of, this whole industry has really taken off, it seems, and there's a lot of really strong businesses in this space. And historically, there haven't been a ton of financing solutions for you all. And we think financing solutions haven't really kept up with this change. So you can flip back still. And so, maybe historically you had either didn't take any financing, or you had some bank debt or tried to go through that process but didn't want to deal with all the warrants and conditions of that, or maybe you even had to bring on like an equity-based partner who could provide some capital to you. But for a lot of people, none of these solutions really fit, and so we're trying to now ease some of your pain points moving forward, and we can move on to the next one. So we know that growing without financing is really hard. You have to be super conservative. You have to plan for any potential bump in the road, can't afford any cash flow gaps. And with that, your focus isn't necessarily on growth, it's on maintaining a healthy business and, growing when you can. And so what we're here to tell you about is potentially a solution that can fit with your business, to open up a bunch of avenues for growth to allow you to take advantage of the strength of your business without having to worry quite so much about the ultra conservative approach that you need to be thinking about. So with that, I'll hand it over to Maria.
Thank you, Adam. So, and one of the reasons we're super excited about this space, as Adam was saying, is really the greatest strength of a recurring revenue business is their future expected revenue, and in the way that MSPs operate make them really, really strong. And this is why this is a segment that we're really, really excited about. So as a result, we believe that there should be a wide range of financing options available to MSPs to help them navigate cash flow challenges and really help them accelerate their growth. And this brings me to revenue financing. So what is revenue financing? Revenue financing is an efficient way to grow your business and help you go to the next level. And we're going to talk about how it works and how you can use it to really accelerate your sales cycle and close customers faster. So what is exactly revenue-based financing? So it's a form of financing that looks at your future expected revenue, and that usually is contracted revenue, and we provide a line of credit on the back of that. So you sign contracts with your clients, and a lot of them are monthly contracts, quarterly, annual, or multi-year contracts, and you know that that revenue is coming in, but it's coming in installments, right? And this can create some cash flow gaps or working capital issues. But with revenue-based financing, you can tap into a line of credit that is equivalent roughly to up to 60% of your future expected revenue, and you can tap into that today to fund your growth. So how does it actually work, right? So once you get access to that line of credit, which is roughly 60% of your future revenue, you can essentially use it on when you need it and only pay for what you use. And it works on demand. So some months you will have more needs, other months you will have less. They're really here you can see kind of like a visual of how it works, right? Like once you have access, let's say that you're a 10 million ARR MSP and you get access to $5 million in a line of credit, you don't need to take the whole 5 million on day one. One month you are going to have bigger needs, the other month you're going to have less needs. You can really tap on it on demand and only pay for what you use, which is a really flexible form of financing that is not commonly found in traditional forms of lines of credit. What's really interesting about revenue financing as well is that it tracks your growth in your scale as you bring in more clients and more contracts, right? So revenue-based financing, usually like every 60 to 90 days, we'll do a quick check on kind of like your performance and how many additional clients you've brought on, and we'll adjust your line of credit hand in hand. So if you were 10 million in annual recurring revenue and you got access to 5 million, as I was saying before, as you bring in more clients, you're going to see that line of credit scale hand in hand with you without having to go through like a massive re-underwriting process. And how does it work, right? So here we have an example of kind of like how the credit line works. So here's an example of a client that got 3.4 million available that we can see here, and they have a cost of capital of 8%. This is a discount rate, which means like for every draw that you make, you're going to be charged 8%. And the term is 12 months on a per draw basis. So this client that got available 3.4 million at this point just needs $1 million. So they select, I need $1 million. And in a very transparent way, you can see this client is going to have to pay back $1,086,000, which the cost of capital is 86,000. And here you can see the payment schedule, right? So this client is going to take 1 million today and repay 90,000 in 12 equal monthly installments. And that's really it. It's as simple as that. There's no other hidden fees, legal fees, non-utilization fees. This is really as simple as it gets. So what are the metrics that you need to pay attention to get access to this type of financing? So obviously, as a revenue-based financing product, what is important is your revenue. So what's your revenue growth year over year? Make sure that you have net positive year over year growth. You don't need to have crazy growth. As long as it's positive and ideally above 20%, you should be able to access this type of product. Margins is also an important one, preferably above 40%, but that's not a hard requirement. Obviously, the higher the margin, the more favorable terms that you will get. Retention year over year is very important, right? You need to be growing efficiently. So for any new contract that you bring, that you're not losing it like shortly thereafter. So retention year over year is great. Ideally 70% retention year over year, but again, not a hard requirement. And lastly, like unit economics. Are you growing in a profitable way? You don't have to be profitable as an entire business, but like in terms of like how you're acquiring clients, that you have some positive unit economics there. And with that, I'm going to pass it over to Adam, who's going to talk a little bit more about use cases. So what can you use this financing for, and what impact you should be able to see in your business once you use it.
Thanks, Maria. So yeah, for MSPs, we think there's a number of avenues here. The first is on the growth element. We know when you're self-funded, you need to be conservative about your spending. And so it can be challenging to spend on client acquisition, marketing spend, sales related efforts, whether that's, people or otherwise. And so it's hard to make that initial investment for the down the road payoff that might come with it. And so one of the things is when you are able to draw on this line of credit, you have some capital up front to spend to help yourself grow. And you also have the ability to only take small amounts you need as you're going. So you can even take it, test out how that's going, and see if you want to invest more over time. And related is on hiring. From talking to a lot of people, we understand that, mostly people only want to hire when they're sure they're going to be able to have that person, ramped up quickly and really driving capacity for the company immediately. And so, if you do think there's more out there that your company could be taking on, but you're a little hesitant to hire, having that extra financing can allow you to bring on the team members you need to really take your capacity upwards. And so those are sort of growth focused, and we think those are potentially key elements, but there's a couple other ones. One is, if there's large expenses you need to fund. For example, if you want to make an investment in better technology moving forward that you think, for your business is going to be a difference maker for your customer and your value prop, but it's a big initial investment, that's one thing you can use it for. And the other is just filling cash flow gaps, as we've alluded to. Whether it's sort of missed time payments from customers or, a minor hiccup in the road for your business or whatever it is, having that extra cash on hand to make sure you can get through any challenges you're facing and keep moving forward can be, a big stress reliever, and also allow you to really think a little bit longer term about your business and try to do the best for your long term versus being, super concerned about any speed bumps along the way. And with that, on the potential impact, as I mentioned, we think this allows you to give your business the long-term focus you want by making investments that are worthwhile, even if there's an upfront cost to them. And ultimately we want to help you meet your goals, and that can be a few different things. And frankly, we'd love to chat with you all after this to understand what those goals are specifically for you and how we can tailor a solution for you all. But for many people, it's just taking that business up a notch where the scale you get to and the level of profitability you get to is a level up from where you are now, and helps, if this is something you want to run for a while, just operationally be, scaled up. But the other thing is, we know in the MSP space, there's been some consolidation and a number of acquisitions. And so if your goal is to eventually have an exit, taking financing to grow can help you get to that scale that's necessary for a potential acquirer to show interest. And so, we certainly want to tailor a solution that works for you, but we think there's a couple different avenues where growing can still be beneficial.
Thank you, Adam. And yeah, that brings us to Capchase, right? And really our mission is, as we were saying earlier in the presentation, is to help recurring revenue businesses go to the next level through flexible and scalable financial tools. We're extremely relationship driven, and we really tailor clients' funding offer with what they want to achieve in their business. And we're here to hear from you and see if you believe this is a fit for you. Would love to learn more and see how we can support you with financing options. If you're curious kind of like on how the process works, we've built technology to make this process extremely seamless and friendly for you, compared to like all the historical traditional financing options. It's oftentimes like very lengthy process with a lot of paperwork and very inefficient processes. Build technology to essentially collect your financial information in a very seamless way. So would you start this process to get funded? Essentially, you come into our platform and you connect your financial data, your banking data, your accounting data, and your billing data. We've built integrations with all the main systems to collect this data in under 2 minutes. Once we have this data, we'll run it through our underwriting models. We will provide, it's certainly a very automated process, but we have a human in the loop because we personalize offer to those needs, and we want to make sure that we take the feedback that we have from our first call with you to make sure that we make a funding offer that matches your needs. And usually within like 2 to 3 business days, we'll get back to you with either a preliminary offer or some questions that we have if there's something in the data that's not clear. And usually we fund most of our clients within under 2 weeks. Once you have been approved within the platform, you can go in, finalize the legal onboarding. Once you finalize the legal onboarding and you sign the documentation, you will be able to submit your first funding draw. And once you submit the first funding draw, you should have the money in your account within 1 to 2 days. And that process rinses and repeats itself, right? Because it operates like a revolving line of credit that you draw on demand as you need. Essentially, you go back to the platform and you submit your draw, and you're going to have that capital in your bank account within 1 to 2 business days. We will collect payment every month automatically through ACH authorization and debit authorization. So there's nothing that you need to do to pay back Capchase. That happens automatically. And every 60 to 90 days, we will run a quick check in the underwriting through the connections to update the line of credit to account for any additional revenue that you have brought in your business and make sure that that line of credit scales hand in hand with your revenue growth. From the partnership that we have with Channel Program, we want to give an exclusive perk to all the webinar attendees, which is 10% off if your financing rate, if you register in the platform by February 20th. How you can unlock that offer, so you can go to this landing page that we have here of capchase.com/partners/channel-program. If you forget to write this down now, we're going to follow up with an email for everybody that attended this webinar on how to access that and start the process, or just jump on a call with us to learn more. So thank you so much, everybody, for tuning in. This is Capchase again, and we're really helping you with financing tools and growth capital to help you grow your business. And now we'll open it up to Q&A for the audience for any questions that you may have.
Yeah, maybe I'll start with a couple questions, if you don't mind.
Yes.
I think you kind of covered the growth, some of the growth, and we had some folks join a little bit into the presentation. But what are some specific use cases like MSPs could use this type of financing for?
Adam, do you want to take that one?
Yeah, sure. So again, I think there's a few things. One is, it really comes down to what is limiting your growth for your specific situation. And so for some people, that might be, okay, we haven't been able to make the initial investment in sales and marketing to bring in new customers. So that's something where you could get this line of credit, take some of it to start out, test out some sales and marketing efforts and see what your return on investment is there. And if it's working for you, invest more. Another one might be, okay, we're just capacity constrained and we need to hire more, but we're, nervous about the ramp process where the person's not initially bringing in revenue. And so you can use this financing to make sure you're getting over that hump and getting return on your hiring investment. And then the other one we mentioned is, if you need to invest in, better technology, new software license, whatever, and the timing of payments isn't going to line up necessarily with your customers' payments, you can use this to fill in your cash flow gaps, to make, your large purchases, and sort of think with a longer term mindset for your business of what's going to help us, create value for our customers and therefore our own business over, the next months and years, even if over the next, month or two, this would have caused a cash flow problem for us.
Got it. So we're getting some questions coming in, some great questions. So I'm sorry if I missed it, but what is the minimum revenue required? Is there a minimum?
Yes, great question. The minimum revenue required is $150,000 in annual recurring revenue. So it's a pretty low requirement. I have to say most of our clients will have at least $1 million in annual recurring revenue, given that we extend a percentage of that annual recurring revenue in a line of credit. So the more ARR that you have, the more line of credit that you will have access to. But we can totally start a little bit earlier than that and scale with you as you go. Other important requirements is that you have at least 3 months of cash runway if you're not profitable. So at least 3 months of cash runway would be important, and that's pretty much it.
Got it. I guess it's a couple questions similar along the lines. One was asking about what dollar threshold meets your model, and then another one's do young companies with no established customer retention rate yet fit your model?
Retention is definitely important for us, right? Because one of the top use cases of our capital is for you to go and invest in customer acquisition, close more clients faster. So it's very important that you do that in an efficient way as well, and that for every customer that you acquire, that you're retaining the vast majority of them. So our rule of thumb is roughly at least 70% annual net retention rate. So if you are not there yet, I would just kind of work on that retention model before you choose to kind of press the gas on growing faster. Solve that kind of like retention problem first, and then once that's more solved, then you go ahead and you scale your growth with a financing option like Capchase.
Got it. Another one from this one is from Michelle. Is the only payback term 12 months?
Yes, and it's important to highlight that it's 12 months on a per draw basis, right? So the line of credit, with the example that I gave, that you get access to $5 million, so that you have to pay the $5 million on 12 months. Like for every draw that you make, it's a 12-month term. So whatever I draw today, I'm going to repay it into 12 equal monthly installments, and next month we'll have another 12-month term. So it's like a revolving line of credit. And most of our customers are under 12 months. You can also choose to do 6 months. And if you do 6 months, your cost of capital will be half of what it would be at 12 months. So we were saying in that example that I gave was 8% cost of capital for 12 months. You choose a 6-month term because you just need capital for less time. Your cost of capital would be half. So it would be 4%. So all is to answer that yes, most of our clients are at 12 months on a per draw basis. We have a very small number of customers that are above that as they've built credit history with us and we've built a relationship with them. We've extended that to 18 to 24 months, but that happens a lot later in the relationship.
Got it. Another really good question from Rich here. We have 90% customer retention rate in the last 7 years who don't use or do not use long-term contracts. Everyone's month to month. Would that qualify for this model?
So as long as there's some form of like contracted or guaranteed revenue, that's what's important. Like we're looking at like the contracts that you have with your underlying customers, whether that is monthly contracts, quarterly or annual or multi-year contracts. And that's what we're going to underwrite. Obviously, the more time frame that you have contracted with your customers, the better you will perform in underwriting because like it has more predictability into that revenue. But in short, we can work with customers that are, or we can work with companies that have customers month to month as long as there's like a contracted component to it. It's not like every month after that you renew after every single month.
All right. Jason's got another good question. They're coming in hot and heavy here. Do you need to read every contract?
No, we don't. So in our billing, so as I was talking about the different data connections that you need to plug in at the beginning of the underwriting process, that's banking data, accounting data, and billing data. Within billing, we have integrations with companies like Stripe, ChargeBee, Recurly, Maxio, that all your contract information is there, and we just pull that automatically and feed it into our underwriting process. If you don't have any of those systems, we would ask for you to send us a breakdown of your of essentially like a summary of your contracts by client, month by month. Not send us every individual contract, but send us the summary of like the contracts that you have across all customers divided per month. Obviously, if you have the integration, much better, but in the absence of that, there's ways to go around it.
Got it. Sounds like it's pretty collaborative, I guess, in kind of the discovery and getting this thing, set up, this type of program set up.
Yeah.
Right. I have some thoughts. Maybe I'll kind of, my thoughts, right, on, this is a relatively newer concept to the industry, right? I mean, it's kind of follows this, I always talk about this concept of maturity, maturity model in this space. a lot have gone from this month to month or break fix, and then getting into annual recurring revenue contracts. And it's, you still see there's a lot of companies that are extremely quality. They're doing month to month, but this hasn't been a big topic until recently in this space. I don't know if you guys have some thoughts on that. I mean, it's very well established, obviously, in the SaaS recurring revenue business model. But any thoughts about why you guys are looking toward the MSP market and as a future growth market?
Yeah, I mean, some thoughts about that. I think just historically, like most recurring revenue businesses have had this clash of, customers always want that flexibility of going month to month, but you yourself want to have that assurance that that revenue is going to be coming in, and you want to actually be paid annually, right? So there's always that clash between your customers wanting flexibility and you wanting to get paid up front. With companies like Capchase, and this is why Capchase kind of like grew really fast, it's like we're easing that pain point in between, right? Even though you can allow your customers to pay you monthly, even though they're under an annual contract, but you allow them to pay you monthly. And with a resource like Capchase, you can recoup that revenue and have access to that revenue on day one, right? So if you have 100 contracts that are paying you, $1,000 per month, instead of having to wait every month for that to come in, with a financing option like Capchase, you get access to up to 60% of that revenue on day one in the form of financing.
Awesome.
So MSPs were super excited, obviously, because they have very strong, sticky, predictable recurring revenue, and we just think it's a segment that has not had historically access to financing options, and we think like that's definitely a missed opportunity. And we're really confident that working with MSPs, one, we can do really well because this is a great vertical with very predictable revenue, and I think MSPs have an incredible opportunity to grow even faster and really fill those cash flow gaps and really go to the next level in a very seamless way that they haven't been able to in the past.
Yeah, and just
go ahead, Adam.
I was going to say, just to add on to that, I think one thing that from our standpoint seems like happened is, when these businesses weren't necessarily structured the same way in terms of recurring revenue, the financing world might have decided these are not businesses we can finance in certain ways. And as that's changed, we're not sure that anyone was paying attention to sort of reevaluate the space. And as we came across it, we realized, there's an opportunity here where these are really strong businesses in a space that's got a lot of growth potential. A lot of these companies are really growing, and obviously IT services are only becoming increasingly important. And so the potential to continue to grow, but now have a business model that maybe has been undervalued in the past, we think has been sort of a disservice to the industry, but also an opportunity for both us and MSPs to potentially create some value that hasn't previously existed.
Well, good news that we agree wholeheartedly. So we got questions. They keep coming in hot and heavy. There's another one from Jeff. You mentioned that one of the acceptable use of funds is customer acquisition. Do you have a list of acceptable uses and the required reporting of use of the funds?
Yes, great question. So we have a list of ideal use cases for our capital, but we don't force the capital to go to a specific set of use cases. But given the term of the product and the fact that it's like a shorter term financing product of 12 months, it's not like 2 years and beyond. There are certain use cases that are ideal to make sure that your business continues to be on financial health, right? So customer acquisition tends to have a very predictable payback period that you're aware of or you can control. Right, and it's usually below 12 months, so that's why it's a great use case for that. Working capital, filling cash flow gaps, sales and marketing hires, whether it's like a BDR, an account executive, a sales manager, a customer success representative. Those are typical roles where you have a predictable break-even point on those, and they're usually below 12 months. So that's why that's like an ideal use case of our financing product. Where we don't recommend our capital to go to is things like making an acquisition, right? M&A usually have longer term ROI periods, usually above a year. So it wouldn't be safe for you to use our financing for an acquisition because it's a straight 12-month amortization schedule where you're going to start paying part of the principal, within 12 months. So we don't force you to use our capital for certain things, but we certainly work very closely with you to make sure that you're using it in the right way. And that's something that I haven't mentioned yet, but for every customer that we have, we match them with a growth advisor, which helps them make the best use of the line of credit that's available to them. We oftentimes put models together for them to understand for the milestones that you want to achieve as a business within the next 12 months. Here's the schedule of draws that we recommend that you take from our line to really achieve those objectives. So it's very much like best practices, and most of our clients follow those, but we don't necessarily force that.
If you're therefore, we get a couple more questions here. One is, are there any credit checks of any sort, and they are part of the underwriting factor? Would this appear on my credit history as well?
No, so we don't run personal credit checks, and there's no security interest or personal guarantee. So in short, the answer is no.
Good deal. And then I guess one of the ones here, if you're not eligible for revenue-based financing, what are things that some MSPs can do to then be eligible at some point?
Yes, so great question. So based on the requirements, right? So you want to have at least 150,000 in annual recurring revenue. So if you're not there yet, try to close more customer contracts to be able to be eligible for that. As I was saying earlier, get your retention and your churn in control, because before you press the gas, you don't want a leaky funnel of every customer that you bring in through financing options, and boom, you lose them. So certainly get your retention in check. Make sure that you have enough cash balance on the bank, have liquidity for 3 months, have runway for 3 months. So that would be really important. And within additional requirements is having at least 20% year-over-year revenue growth. So work on making sure that you have at least that revenue growth to be eligible for it. And oftentimes we talk to clients and they're not ready yet, and they want to talk about what specific milestones they need to hit, and we work with them to then say, okay, these are the things that you need to achieve, especially you as a business. Let's mark the calendar to check in again within 6 months because we think that's going to be a better time for you to reconsider this option. So even though you're not ready yet, you might still want to check in with us just to make sure that we have you in our radar, and when the time comes, we're ready to kind of start the process.
And related to that, with the type of financing we do, it's not in either of our interests to fund you if it's not a good fit. So you guys should all feel free to reach out and have a conversation, and we'll try to feel out whether it's a good fit, because what we're really going for is companies that our financing can actually help them and the partnership can grow over time. It's not in our interest to give you financing that is going to be hard for you to pay back or is not going to benefit you. And so if you want to have a conversation, see if this is a good fit, there's no obligation, anything like that. And it's not going to be us pushing you to do this. It's going to be us both feeling out, is there a partnership here? Because this is sort of a long-term payback period. And for a lot of our customers, they come back and do another line of credit in the future, hopefully at a higher amount as they've scaled up. That's really the relationship we're looking for. And so we'll be, very careful to make sure we give you all the info on how this works, what we think you should do with it, whether it makes sense. But if you want to have an initial conversation, we're certainly happy to do that and see if there's a fit.
Awesome. Well, one of the reasons why I was excited to do this is that I've been exposed to others in this marketplace, and just the level of collaboration that you guys and education, honestly, that you guys have provided has been pretty incredible. So I really appreciate the kind of dedication to the upfront process and just navigating that, making sure that there's education on both sides about the company and then about really what to expect and whether it's the right path to go down or not. So I think that's kudos to you for being collaborative on the front end. So, and you mentioned it's about having a conversation. So I guess a good segue into Pereda. If MSPs are interested, how should they get in touch with you?
Yes, and it looks like Michelle just came in with a last question that I want to make sure I address. If a company is ready and has a little bit of work to do, will the 10% discount still be honored in the future? And to clarify, Yes, if you reach out to us by February 20th to have like an introductory conversation and you know, get and understand a little bit more what you're doing and see if the financing plan is good for now or later, that discount will still apply. So I certainly would encourage everybody that's interested in learning more and starting the process now or a little bit later to reach out by February 20th to make sure that you can access this discount when you're approved the funding offer. So how can companies?
Maria,
yes.
one more I think we missed is someone asked also, are you allowed to prepay?
Oh, yeah, I did not see that. Yes, you can. You can prepay whenever without a prepayment penalty. Now, our product, I would say it doesn't have a prepayment penalty, but it doesn't necessarily have a prepayment incentive. So what does that mean? So in that example that I was showing earlier, where you draw $1 million today and you need to repay $1,086,000 in 12 equal monthly installments, let's say that you want to pay the balance on month 6, you will still have to pay back $1,086,000, meaning the discount rate that you pay, whether you stay the full term or you pay early, is still the same cost of capital. But beyond that, there's no prepayment penalties. What we do work with clients that think that they're only going to need the capital for 6 months, then we're going to give them a 6-month term, right? So say like, okay, this draw, I really only need it for 6 months. You're going to have a shorter term, and that way you don't have to pay the cost of capital as if it would be 12 months.
Awesome. Yeah, thanks. Yeah, these were coming in hot and heavy, and I missed a couple here. So thanks for picking that one up there, Adam. But yeah, so I know Caitlin's been putting up the link here. We've got a landing page, capchase.com/partners/channel-program. But Caitlin will put up that link, and then we'll provide links to everyone post event as well. But so just Maria, Adam, I thank you guys for hopping on. Like I said, it's be able to bring these types of solutions to this industry when we're just all getting started, because I think this is something that the MSP space should be looking at as a great alternative, great partnership. So I want to thank you guys for joining us today, and look forward to helping everybody out there in the future. Thank you very, very much.
Thank you very much, Kevin, and the entire channel program for having us here. And thank you for everybody that tuned in. Excited to learn more about your business and see if we can work together.
Thank you all.
All right, well, thanks everyone. We'll send out an email with the recording and how to contact, as I mentioned, Capchase. And that'll be sent out tomorrow. So stay tuned. Thanks, everyone.
Thank you.